Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you guys in depth an annuity versus a 401k plan and really decipher, the major differences of them, the pros and cons of each, when someone might leverage their 401k accounts or old 401k accounts and try to roll them over into an IRA annuity, why that might make sense or why annuities might really not make sense at all for an individual situation. So I really want to unveil some of the BS that is out there regarding annuity contracts being amazing or being horrible. So it really depends upon an individual situation and what their plan is, what their exit strategy is when they're looking to stop working and kind of a whole slew of different things. So to get started, what is a 401k plan? Now, a 401k plan is an employer-sponsored retirement plan that's set up through a specific entity. So if you're working for a private institution, you're most likely going to be offered a 401k plan if you're an employee of that institution, just like if you work for a state or nonprofit organization. They might be offered something known as like a 403b plan. Very, very similar. Basically, you have to think of this, or what I like to explain it is, think of this type of account in the form of a bucket. So if an individual is working for a company and they're saying, okay, I'm making X amount of thousands of dollars per year, that employer could say, well, we also have a type of retirement plan established for all of our employees that you could take portions of your salary and designate that into a type of retirement bucket. So if we have an example where an individual is making $100,000 in a given year and they say they want to put 5% of their salary away for retirement, well, rather than them try to figure out an IRA on how to place that or put that into a regular savings or checking account or whatever that might be, they could go and have their monies taken out of their paycheck. So it's kind of like that out of sight, out of mind, and they have those contributions now going towards this 401k retirement bucket. So the 401k plan is going to accumulate by the contributions that are being placed into this account. And then the second component is a rate of return that's being placed into that account. So the 401k usually has anywhere between 5 on the low end to about 20, 25 different funding options to choose from. So if you are currently offered a 401k plan, you might see this as, a mutual fund or a target date fund or an ETF or a stock or a bond. It might make up a whole plethora of those 5 to 25, 5 to 20 different funding options. So an individual might be 100% invested aggressively into, a stock portfolio based upon their 401k options, or they might say, okay, 25% to the aggressive fund, 25% to a conservative fund, 25% to a target date fund, 25% to something else. So there's a whole slew of options available. So it's off of these different 5 to 20 options to choose from, which will make up how this person creates their 100% allocation into their bucket. Why is that important? Well, it's important because it's all based upon rate of return. If you're picking correct options and those options are producing a favorable rate of return, well, then your 401k bucket is going to increase by the contributions that are being placed into this bucket and the positive rate of return being placed into this bucket. That's going to result in compound interest working in a positive direction and therefore having a larger bucket at the end of the day, at the end of the year. So when 401k plans were very successful and, not really planning on the best strategies were very successful was between 1980 all the way through 2000 when you had these different funds were linked to the stock market, to usually U.S. domestic markets. So what this individual would do is say, I'm going to invest my money into the market, choose an aggressive portfolio on their 401k, try to max fund their 401k, and it would be the combination of the contributions plus that nice rate of return from 1980 through 2000 that would be adding larger and larger sums into that 401k bucket so that right as they're nearing retirement, they have a nice large bucket that's sitting there. That was, basically the glory days when markets were doing really well. There was no true downward market losses that were really scaring individuals. And when they were investing into the markets, they were thinking that, that this roller coaster will never, or this upswing will never go down. It will just keep trending upward, upward, upward. And then you hit those 2000s, and then there was an economic shift that essentially took place. And what I mean by that is in 2001 you had a slight market decrease, and then in 2008 you had a very large market decrease. which made individuals realize, especially seniors and baby boomers, that they were about to call it quits. They were about to exit, meaning, go into their retirement plans, or start to dip into their 401k accounts for retirement income, and then they got rocked with that rate of return coming back negative. So in 2008, as an example, individuals could have walked into the year with $1 million in their 401k accounts, could have walked out of the year with 700,000, 600,000. So they had large minus 30% losses, minus 60% losses into their portfolios that year, regardless of how much they were contributing for all those other years. That 1 year of a downward market loss of that rate of return coming back negative really had a large impact and essentially sliced their bucket in a third, sliced their bucket in half, depending upon how heavily invested they were into the domestic markets. So why is it so crucial when I mention that negative? Is because when somebody's nearing up for retirement and they're accumulating their dollars into their 401k account, there has to be a proper strategy in place. If they're looking for that accumulation phase, well, how do they choose their allocations properly to make sure that it's growing on that uphill battle, that's basically growing on that uphill trend, to capture markets, to try to receive gains when the market goes up? Or what's a strategy to receive gains when the market goes sideways? Or what's a strategy to receive gains when the stock market goes down? And what exactly are the different options available for a 401k, so that an individual could properly choose what the best allocations are to make sure that they're getting that positive interest rates. The opposite side of the coin is not so much towards the accumulation, but now it comes to the distribution and the preservation and distribution phase, meaning that now you have an individual that's nearing, age 60. Maybe they want to retire at age 60, age 65, age 67, and correlate that to a Social Security income need, and they're still susceptible to these downward market losses. And this is something that I try to explain in a lot of my videos, known as RDCA, reverse dollar cost averaging. And what it says is you want to eliminate the negatives with the market and the negative impacts to these retirement buckets that could compound interest in a downward, basically in a downward position, rather than grow your accounts. These little simple fees and these simple negatives could compound interest against your accounts, resulting in you outliving your retirement accounts, and resulting in your accounts becoming $0. And what I mean by that is, if you have a typical 401k account that's invested in mutual funds, maybe those mutual funds and those 401k related fees are right around 1%. So that's a negative. That's a hole. That's a negative already going into your bucket. If you're utilizing a financial advisor and they're charging you fees to monitor that account or give you recommendations, maybe they might be charging you another 1% fee or a flat fee right around 1% off of whatever your bucket is, for their expertise, for their advice. So with that aspect, when you're nearing retirement and you're just trying to choose the best funds, well, you're already minus 2% in the hole before your account's gaining anything. If you get rocked with a downward market loss, and a very realistic example would just be like a minus 10% loss, well, that's a further negative. Now you start pulling out monies from this account and saying, okay, I need income from these accounts to live off of for retirement income. Well, now that's a fourth negative. Then you're incorporating inflationary risk or purchasing power risk, saying that the pace of inflation should increase between 2 to 4% in a given year. So now that could have a negative impact, saying maybe you might need to pull out more and more monies as you keep living further and further into the future. So you have all these little negatives, these micro holes that are coming out of the bucket, and that downward market loss being a very, a crucial impact that could result in a retirement failure. So that's where the 401k plans have their flaws. 401ks are very good when you're receiving a company match, when obviously your money's accumulating properly, if you're investing it the correct way. Obviously the accumulation phase could be very, very good. But when it comes time for that distribution, that preservation distribution phase, that's where individuals start looking elsewhere towards a more conservative play, whether that's a conservative growth play or whether that's to provide a lifetime income stream by leveraging like an IRA annuity account or a type of annuity account for that retirement income need. So on the caveat, on the opposite side of the coin, what exactly is an annuity? An annuity could be set up in a whole variety of different ways. You could utilize it from cash, known as like non-qualified annuities. You could utilize old 401k accounts and roll them over into traditional IRA annuities, which are deemed qualified retirement accounts. And the main purpose for somebody to do that is if they have an income need, a retirement income need and they want to receive lifetime income, um, and make sure that's a very safe lifetime income, kind of like a pension plan, but you're setting up more on the private side through insurance companies, you can set up that income need through an annuity, through a specifically designed annuity contract. If you want to have more safe, consistent growth, not necessarily large growth, because annuity contracts restrict a lot of individuals on growth. Like you could go into a similar annuity contract like a 401k, which is known as a variable annuity, but it's very expensive, and majority of times variable annuities do not really correlate to that growth strategy. So this is why I say an annuity, if you're looking for a safe, consistent growth play, you could utilize fixed annuities or fixed index annuities to give you gains, either fixed interest gains that are going to remain fixed for the life of that annuity or for a set duration of years, or a fixed indexed account that is going to gain when that stock market index that's linked to goes up, increases each year, or gain 0% when that stock market increase goes down. So from a growth standpoint, if the individual is looking for safe, consistent growth, an annuity might make sense. Or from an income standpoint, if they're looking for that lifetime income stream, that's when an annuity can make sense. Beyond that, if someone's looking to be super aggressive with their monies and really accumulate, if they're really behind the curve and they need to accumulate their dollars for retirement savings, an annuity is not going to be the correct route, especially if you're looking to leverage those 401k monies, or at least based upon my personal and professional opinion. So a 401k, we understand, is set up through an employer-sponsored plan. So it's set up through that person's employer. An annuity is set up through the individual. So whether they're utilizing cash and it's a non-qualified annuity, it is directly affiliated to whoever that annuitant is or the owner of that annuity contract. If they're utilizing 401k monies and they're rolling it over into a qualified annuity, it has to be into an IRA annuity, an individual retirement account annuity. So it's more for the individual as opposed to that company, as opposed to the employer that that employee is working for. So an annuity it has to be established through an insurance company. Banks cannot offer annuity contracts. It has to be through legal reserve structures through an insurance company. And a couple of ways on how this can be beneficial, or where someone can leverage it for their retirement or their growth need, would be for, let me actually clear out the screen. And I'll go through an example to provide an individual with pure retirement confidence, leveraging a portion of their 401k and placing into annuity, or a portion of their 401k and putting into specifically designed IRA contracts that are not eligible or should not be placed into an annuity contract. So the first situation, let's say we have an individual that's currently age 60 years old. They have $500,000 that's sitting in a 401k account, and their employer says that yes, because they hit age 60, they were able to take a portion of this 401k and roll it over into an IRA account. We understand with this individual that's age 60, this person wants to retire at age 65 as a hypothetical example, and they need exactly $50,000 of income each and every year from age 65 to the rest of their life. So whenever somebody's trying to prepare for retirement, they're currently in retirement, there's three main criteria that need to be figured out in order for that individual to stay retired forever. The number one thing is they need to have ample amount of income sources. So with this scenario, we understand that at age 65, they're going to be working for the next 5 years. At age 65, that's when they want to retire. Maybe at age 65, this person is going to be receiving Social Security income of $35,000, and therefore they do not have any other income sources. They don't have any other pensions, and therefore they have, in this case, a $15,000 gap that they need to make sure is covered. So what somebody could do is take a portion of this $500,000, roll it over into an IRA annuity contract with a 5-year deferred annuity contract that will provide them $15,000 of lifetime income till the day that they pass away. So if this person, lives till 110, 120 years old, $15,000 is still going to them. Maybe out of this 500,000, maybe it's only going to cost them 100 grand to place into that IRA annuity and make sure that that income source need is covered. To say at age 65, they receive the Social Security income, they receive the annuity income, and they're receiving that $50,000 each and every year. Number two, emergency funds. They need to make sure that they have ample amount of emergency funds. So if about rule of thumb is in between 6 to 12 months of emergency funds should be set up for an individual's need in case of an oh my gosh moment that occurs. So therefore, out of this, We understand they have access to the 500,000. 100,000 went into the IRA annuity. So that's IRA number one. That was with an annuity. IRA number two could be set up in a money market account. This does not qualify for an annuity. So this is something that's pure liquid cash. And let's say that they need $50,000 into IRA number two. That suffices their income sources. That suffices their emergency funds. So out of this 500,000, they were able to now have $350,000 left over. Well, that's where number three comes in for pure retirement confidence, is that inflationary need. So they could structure with annuity process, they could utilize annuities in a laddering strategy to say that at age 65, they have that $15,000 annuity that comes in. Maybe at age 68, they have another $2,000 that's triggered of income stream. Maybe at age 71, they have an additional $3,000. And the reason why that's important is because each time that they're triggering those income sources, those annuity, those micro IRA annuity accounts, it's going to correlate to whatever their inflationary need is. So this inflationary need can be set up through laddering strategy through annuity contracts to provide them that lifetime income stream, similar to how Social Security or how a pension income would come to them, for further peace of mind. And we can mathematically calculate how much of an annuity that they need to place out of their remaining $350,000. Maybe that's going to qualify for another, 3 annuity contracts and use another 100 grand out of that to now have $250,000 left over, that now they could roll that over into a specifically designed IRA contract that's not associated with annuities. This $350,000 for the inflationary need might not have to be used for an annuity. You could just use this and try to grow those monies properly, something that gives you a lot more eggs in your basket to choose from than with the measly, 5 to 20 different funding options through a 401k account. So what I mean by that is if somebody is offered a 401k plan, and let's say that same situation, they're age 60, they want to trigger income at age 65, or they want to retire at age 65, well, let's go back to our chart of income sources, emergency funds, and inflationary protection. This person has $500,000 sitting in a 401k account, and maybe at age 65, their need is $50,000. And let's say at age 65, they're receiving Social Security income of $35,000, and then they're receiving pension income of, let's say, $30,000. Well, that's going to equal 65 grand of lifetime income. There's no reason in the world to put that money into an annuity contract to go and leverage any portion of these dollars, because they've already sufficed what their gap is, what their expense need is at age 65. $65,000 would be provided to them through the pension income of lifetime income and then through the Social Security income. So therefore, they do not need to leverage an annuity contract. And this is where a $500,000, I apologize for that, $500,000 rollover into just a specifically designed traditional IRA would make more mathematical sense than a 401k. And the reason being is for that reverse dollar cost averaging effect. Why would you leave your dollars susceptible to 401k, to high cost 401k related fees, high cost mutual fund related fees, and limited funding options between 5 to 20 if you could go and roll your money over into a traditional IRA account that's more customizable, something that would give you options as high as 3,000 to 5,000 different eggs in your basket to choose from, something that's cheaper than the mutual funds being offered in your 401k, maybe something that's more customized to individual stocks, bonds, ETFs, whatever that case might be, so you have cheaper fees with a higher quality average rate of return than what the options are available to your 401k account. So that is how a traditional IRA that's actively managed or passively managed account might do better than going and leaving your money susceptible to an annuity option, because you heard from an insurance agent that they kept pushing you and telling you all these great things about annuities. If that income need is not there, an annuity might not be necessary. Now, one of the other things I mentioned is I said that an annuity can be set up for safe, consistent growth strategies, and that's more on the fixed annuity side or the fixed index annuity side. When somebody is just looking to leverage a portion of their dollars, throw into some sort of safety account, and just have that nice consistent rate of return. So like maybe a fixed account, they just want something flat that's paying 3% rate of return from now into the next 5 years, that pays a little bit better than what bank CDs pay. That might be a good fixed annuity route. A fixed index annuity, if they're looking to receive some decent consistent gains, anywhere on the low end about 3% rate of return per year to 8% rate of return per year, and they don't want to have any mutual fund related fees, any advisor fees. They just want to receive a credit or receive a gain into their account when the market goes up and not lose anything or not have to pay any advisor fees when the market goes down. That's when an FIA contract might work out really, really well. But regarding that situation, the $500,000 situation, it might take just a very small adjustment, maybe $100,000, $150,000, depending upon that individual situation, to accomplish that safe accumulation need, not the full 500 into that annuity, because there are restrictions with annuities. You have to play by the terms of that contract in order for them to provide you lifetime income, in order for them to provide you that growth with no downward market losses. There's got to be a give and take with the best annuity contracts. And this is where we come in. We really try to help you guys out. We're an independent agency, so we have access to every carrier out there. There's 1,200, 1,300 plus annuity contracts per state, per an individual situation. So this is why we try to help devise what the best plan might be for you, to let you know whether an annuity makes mathematical sense or whether it doesn't. So if you're interested in this video, if I kind of hit a couple of hot buttons, make sure to give us a call. Our 1-800 number, 1-800-566-1002. We offer 24/7 customer service, so you give us a call mornings, nights, weekends, holidays, whatever the case may be. And it's just as an additional opinion, we have all the best systems. We have something known as Retire Sharp planning system out there to allow us to decipher, what are the best strategies. Might be an annuity, might just be, a different strategy on accumulation phase, whatever that might be. But we're going to give you very non-biased information and allow you to be comfortable throughout the entire process. We also opened up a digital calendar. So if somebody's looking more to speak with a specialist and you want to make sure that you are getting in touch with the correct specialist at that point in time, you could also go to our website, retiresharp.com. And what this is going to do is give you some little literature pieces, little ebooks, things like that. And then you're going to see this little book your strategy session is going to pop up on the bottom right hand side, where you could actually schedule an appointment so you get more specific with that specialist rather than calling in. So we want to make sure we're available for you guys, and we know that you're going to be very satisfied with the result. And feel free to give us a call. When calling into our 800 number, you're going to speak to an assistant. You're going to tell them that you saw a video online and you want to speak to a specialist, and they'll patch you through. Or if you set up the calendar, you could just we'll make sure that the specialist is already waiting by, and you'll receive confirmation email messages and all that, depending upon your schedule and our schedules with the top advisor. So I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.